everybody. Welcome into the Stock Market Brief Show. If you're new here, welcome to the show. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. We have timestamps in the description below if you are on YouTube. If you're new here, well, make sure to hit that thumbs up and subscribe to the channel if you haven't done so already. If you need a show where it gives you insight into the markets, Monday through Friday is when we try to get our videos out at about 6 o'clock Pacific Standard Time, 9 o'clock Eastern Standard Time. We're going to hop right into today's market performance. If you take a look at the 11 sectors that make up the S&P 500, we had a few laggards. They tend to be in the more risk-off type basket, and then we had some relief up in the financials, and you could see here over in the index products, everything was pretty much unchanged for the entire day, meaning the Nasdaq, right, the Nasdaq composite, we had the S&P 500 pretty much unchanged, and the Dow Jones unchanged. The one that stood out was ding, 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 right over here. The small caps were up almost 3%. Same with the mid caps, up a whopping 2%, and that could very well be led by energy and financials because we have a lot of small caps within those sectors. Now, if we take a look at year-to-date performance, we still have technology, communication services, and XLY leading the charge, which tells us that, hey, we may very well be building out a market bottom if you look at cycle analysis over here. However, one thing that we've been discussing is on the blue, which is the business cycle, we have yet to be told that we are in a full-blown recession. So when you really think about this and you kind of, say, okay, this sector is doing good, this sector, well, the next one on the list is industrials, and that really comes into play more towards the end of a recession or potentially earlier, and we're going to get into that in that section of the video. Let's take a look at a post from the Almanac Trader. This is seasonality for the month of June. So you can see day 1 over here to day 21, the trading days in the month of June. And then you have the percent change, and then you have the products themselves. And what you'll notice here is something very interesting. Around the 6th, if you just look straight up, boom, you start to see some separation between the two. And what's the separation? Well, the dashed lines represent pre-election years. Okay, so this is to me is interesting because we are in a pre-election year, and what you'll notice is even here around June we get these pullbacks, but then all of a sudden we start to see more strength actually into and around the 15th to 16th, and then you start seeing a pullback follow suit. So do we have more gas in the tank? That's what we'll be talking about in these various sectors and where we could potentially look for targets. If you guys don't know already, I do have a swing trader community. I use Discord, but you got to sign up through Patreon, sync your Discord up. It's only $9 a month, or you can pay annually. It ends up being like $90. That's where I give trade ideas. I give watch lists, monthly expected moves, weekly, daily, zones, just a whole bunch of information. Then you get access out to the community too. Just some recent trade ideas. This one was ticker symbol HZO. The chart was not looking good, but it was a short squeeze candidate because it has a 15% short float, and it did look like the IWM was going to take off there, and boom, this thing fired off like a rocket ship, up 12%. BBIO was a recent one too. It was right around that year-to-date anchored VWAP. It was contracting right here, and boom, that broke out today for about a 9% plus gain. Now, this isn't always the case, but many of the trade ideas that I look at are periods from expansion, and then they contract and get very tight, and then we offer an area where you say, okay, if the trade starts breaking a certain level, get out of it. Just good risk to reward trade is kind of the things that I like to look for. We're going to hop into the S&P 500, looking at the daily time frame. So as you can see, we got below that quarter to date. We said if we get back above it, start to look to see a couple of gaps filled, which we filled those two gaps as prices one day separated from a new 2023 high. And as it stands now, we are just currently consolidating after this recent move higher. So if we do have more gas in the tank, I feel like it would want to come and at least try to tag the August 2022 high, which would give us at about a $3.7 per share movement from where we are currently. So that could be a level of interest to pay attention to that's slightly above the 430. And if I drill down even further into the 15-minute time frame, you'll see here how we're just kind of consolidating this recent move higher, and bullish. This is technically in bullish bullish territory, or it's a bullish consolidation because we're above an inclining 5-day moving average. If we were to get hit to the downside going into tomorrow, pay attention to the lower daily expected move. If you don't know what that is, a daily expected move or a weekly expected move, the orange lines, these are levels based off of the options market, based off of implied volatility. It's what they are predicting as far as risk looking forward. And if you think of this as a bell curve, right? Bell curve, 68% of the time, it closes within one standard deviation. So typically you'll get 68%, 68% chance that we close within this box tomorrow. And this opens up opportunities because sometimes if we get outside of it intraday, we come right back in, creating some opportunities in the trading session. Now, this white line represents that the daily time frame, the 3.7 up higher. So if we do get up there, pay attention to that level, because that's that August high. And then we have above that is the upper weekly expected move. Now, as it stands, we're above the week-to-date anchored VWAP, and we're above the month-to-date. We were talking about yesterday, hey, if we get down here, pay attention to what price does in that area. The SPY did not reach down into that level, but it's still a level of interest if we get hit to the downside. As it stands now, the door's open to head to 430.28 and higher, potentially even test this high right here, okay? If we can start getting above these two prior highs where you can clearly see the bears stepped in. We have a little bit of a shooting star type candle, so it may need to digest more, but as it stands right now, it's looking decent with the current data that we have. If we look at the Nasdaq 100, this one got very, very tight right here, okay? And then we saw an explosive move. Now, these type of moves, they don't last like this, right? They need to go through periods of digestion or pullback or something. So as it stands right now, you need to be a little bit more careful in tech because there's been a big run and we haven't had a proper digestion or pullback or anything of the sorts. And when we had these prior runs before in the bear market, you can see that they got hit to the downside. We got boom right to the upside. And then many people don't remember this, but June of last year, do you guys remember, guys and gals, remember those 3 trading days in June? That was pretty wild. That was like in the middle of June where we just got bam, bam, bam down to the downside. And we're coming up seasonality, a very similar time period, okay? So we have one more gap above us over here before we start to try to take out this April high. And that gives us, a pretty decent move from where we are, 354 to just under to around 360. So that could be a level of interest to also keep in mind there. If we look at the 15-minute time frame, this is where you can really zoom in on some interesting price action. So this is pretty simple, right? Remember, prices move between expansion and contraction. And right now we are contracting, and we're contracting in a very important area. That is underneath the week to date and above the month to date anchored volume weighted average price. So you can see we're ping-ponging, right? We come low, we go high. We come low, we go high. So watch for a break to tell us the potential next direction. If we can start breaking and holding above the week to date, that sets us up to go higher to touch the daily expected move at 358.60 or this prior swing high over here, and also the upper weekly expected move there. Now, if we start breaking down lower, we are still above an inclining 5-day moving average. So I'd be hesitant to short there, okay? But see how price acts, because if it starts bouncing and puts in a lower high, right? We're stair-stepping down lower highs, and then it starts breaking, that opens the door for that lower daily expected move at 351.08, and then it also opens the door later into the week to 347.75 if it cannot recoup the 5-day moving average, if it starts curling back over and you get a series of lower highs and lower lows. Now, I want to reiterate this. This is a monthly chart, and this dashed line here, that's actually the quarterly expected move. And remember, like we said, it's like a bell curve. Boom, bell curve, right? 68% of the time. We're actually trading outside of that. Now, we still have a lot of room to go for the monthly expected move, but just be aware that we're disconnected from the monthly 5 EMA, which is the most frequently tagged, moving average there on this monthly time frame. You can see each month pretty much tags it, and if it gets far disconnected, it snaps back. And now we're far disconnected. Doesn't mean we have to snap back right away, but if we do get a snapback, you just got to be aware of that as we are trading outside currently of the quarterly expected move, and we have still an entire month to go basically. Let's look at the Dow Jones. The Dow Jones Industrial Average, the last time we talked about this, was leading into June as a potential opportunity. And we talked about this flag, and we talked about the transports, if you remember. Well, we broke out, and now we're kind of, if we take a look at this and potentially look at this as an inverse head and shoulders, that could be the neckline where you have a left shoulder, head, right shoulder. And if that actually is the case, and the reason why I want to reiterate this is because if it's actually a market bottom and we just forget the recession altogether, right? We got to think of that as a potential opportunity. I don't think that's going to be actually the case given the macro data coming out, but we talked about it on the other episode yesterday. But industrials would be the potential opportunity here. So when I look at the Dow Jones Industrial Average, I'm like, okay, so if we do start moving up, where's a measured move? Well, if you measure from the head to the neckline and you just take the breakout area to up here, that puts us at around 365, which tells us, boom, there's a lot of room to go if we get a full measured move. And even a measured move like that would, if this was a flag pattern, would be a very similar type area, 355 to 360. So there is opportunity here if we can hold the quarter to date and year to date anchored VWAP, okay? So if it starts breaking down from this area, then I'm like, okay, maybe give the trade more time to consolidate and set up. But if you had to stop here, and even if you entered on breakout, your risk, right? Your risk box to your potential reward box over here, that's a pretty large potential opportunity. If you take a look at the 15-minute time frame, yesterday we discussed the flag pattern that was forming. Well, it basically just continued to just go down up until the end of day. And you can see, what did it tag? It tagged the month-to-date anchored VWAP, and we said, pay attention because you might get a U-turn trade. Well, this little candle wicked down, boom, and then we started coming back into it, recapturing that. But we're still below the week-to-date. Okay, but we're above the month to date. So it's the very same situation here where the 5-day is moving up. So I wouldn't really short it down into this level. I would just wait to see how price action sets up and if it consolidates more and look for a long trade up until a point if price were to get down beneath the 5-day moving average and it was starting to turn around. Now, from a bullish perspective, you do want the week to date to be recaptured. If that takes place, that at least opens the door to this prior swing high over here where we can build on the current low, higher low, higher low. That would be the higher low there. And then we would have a high, we'd have a higher high too as well. So that would mean the trend would continue up. If we take a look at the Russell 2000, a lot of interesting stuff taking place in the Russell 2000. Right, yesterday we had an inside trading day. It was a little bit of a sketchy day, but today the bulls showed back up. Now, I want to just show you this specific chart and where the opportunity may lay. Just understand that we're in a chop box, and the chop box has really been for quite some time. You can see it has acted as periods of support, resistance. We came outside of it a little bit, then we dropped back in, and you can see really fair value within side of this range is around 180 as we're pressing up through that. On a good note, we're above the quarter-to-date, year-to-date anchored VWAP. So the next level of that I really want to kind of hone in on if we're going to get a continued move into the middle of the month, and then we start to see a pullback. Start looking at the all-time high anchored VWAP. You can see price has before came up to it and dropped off, came up to it, dropped off, came up to it, dropped off, came up to it, and dropped off. So is price going to try to swing back up into this area again to retest it, potentially break out further and move higher? But are we going to come and hit this area? And that right there lines up with a bunch of different price action here in this zone. So this 180, I'd say 187, 188, 190 range could be a potential target for price, to work itself up into this area, maybe sooner than we may think, given the context of seasonality. Now, if we take a look here, what did price do? Price came down to the month-to-date anchored VWAP, and it found support. It actually ignited like a rocket ship from that level, and then we consolidated throughout the remainder of the day. The lower daily expected move, 182.11. So, I don't like chasing these big moves. I prefer to see some sort of consolidation or back test. So what you can do is look for the lower daily to get tagged, because that would just be reconnecting right around with the week-to-date anchored VWAP. So if price comes down there, see how it works itself out. Maybe it builds a base. Maybe it just, bounces and, it's like a V bounce recovery. Maybe it gets under, maybe does the U-turn trade and sets up to go higher. That would be an opportunity. If we start really breaking down, watch for the month to date to get reconnected again. As you can see, it's now acted as a level of support 2 times. If we start breaking above this high over here, this consolidation, Okay, if we start breaking above this, that opens the door to the upper weekly expected move and the upper daily expected move, which is actually outside of that area. But as it stands now, overall on the daily time frame, this gap, okay, so if we're really going to get a good move out of this, this could be considered a breakaway gap or a runaway gap where you can go long, right? I'd prefer to see a little bit of a pullback, just like we did yesterday on that inside trading day. And then you have a stop underneath that quarter to day anchored VWAP. And, if you just want to go long and hold it as a swing trade, maybe it goes like this and goes higher and cool, but maybe eventually it just cracks right back down. But you just trail along the quarter to day anchored VWAP. And if you get stopped out, you get stopped out. But for, what if we don't get stopped out? What if it just keeps going like this and then we just keep on going higher and higher and higher? Well, then you have yourself a great risk to reward trade, right? Like I said, if you were to enter here, this was your risk box, maybe if you want it bigger, but then you think, hey, no, if this is actually building a bottom and I think we're going to go retest the all-time high or even half of that, you're still looking at risk to reward right here where, there's quite a big benefit there. Let's hop into some indicators. We're going to get into a couple of more things and then call it quits for the night. BPCOMPQ, this is the bullish percent index for the Nasdaq composite, getting overbought. BP Utilities, oversold condition. Yeah, there's few stocks really in this, so, could stay oversold for quite some time. That's why it looks chunky. But yes, it is in oversold conditions. We talked about this one yesterday. The technology sector is getting a little heated as that negative divergence is starting to play out. If you look at the percent of stocks above the 50-day and 200-day in the S&P 500, as the price is going higher, you can still see that, the percent of stocks above the 50-day and above the 200, it's lackluster. It's less than it was prior to this high as prices pushed higher. So fewer names are obviously are moving this market, okay? So we're starting to see positive breath as we've recently saw a little spike here. But if you measure it to where we were over here, there's a little bit of a negative divergence. As far as the summation index goes for the NYSE, we had that bullish tick over. So that's identifying a potential change in trend right there, right? We had a potential change in trend here. Boom, it moved down. Okay, now we have a potential change here. Maybe this is telling us that, hey, this is going to start breaking out and we're going to start seeing a push higher. This was identifying a change in trend over here where the parabolic arc ticked over and boom, we went down. This was change of trend here, boom, we went up. So we're just at the early stages here. So that's going to be something to consider. On another thing that we look at is back month versus front month volatility. The VIX has been getting completely suppressed here. A lot of people are saying the VIX doesn't matter. I kind of err on that right now because of zero date options trading where the vol has been seeming a little off, and the VIX does not include zero date options in its calculation. So the VIX has been getting suppressed, but then it's significantly below back month volatility by a factor of 22%. And as we've seen in the past, when that line gets up into these ranges, it creates potential tops. At least in 2022 it did, and then even periods of consolidation as it did here. So we've been trading rather frothy when it comes to that. Last indicator I want to talk about is the Saylor to Schiff tool is starting to flip over, so the signal has turned positive. There's not an official trigger, meaning it's not like part of my strategy personally, but I'm showing you this because yesterday it wasn't there. Today, now it flipped over, boom, okay? And if we look at price of Bitcoin, it could very well be flagging, opening the door to potentially get us a real signal trigger, which, who knows what can turn into. It could be a nice rip like that. It could be nothing. It could be a whipsaw like we've been seeing. It could be even something huge like we got this buy signal here and it went up, fourfold or whatever it was. So that is a positive sign. I'll talk more about it on another episode, or you can watch my episode that I built specifically for this. I teach you how to make it, use it, and so forth. And this now is also showing some strength in some various crypto equities to keep in mind. If we are going to get that official trigger, it could very well help out not only Bitcoin, Ethereum, other cryptocurrencies, but also crypto equities. Let's look into commodities. We'll then take a look at Bitcoin. As you can see, we had that big move down, and then all of a sudden we snapped right back, and that's what really helped out that indicator flip back over. We almost reached down to that 25,000 range, but didn't quite get there. That was kind of the target we were looking at back right before this broke, as we were talking about, right? Expansion leads to contraction. It got really tight. We expanded again. Okay, and now on the weekly time frame, we're starting to contract, right? Expansion, contraction. It's getting very tight. Let's go on gold. Also, it's holding up rather well over here. We talked about this move right here. It's creating what's known as a falling wedge, which could potentially be bullish. I don't care, bullish, bearish, whatever. All I like to see is prices contracting, meaning that, hey, it's giving us a good risk to reward. So if you play long on breakout and then it gives you like, okay, well, if it starts getting below 1925, all right, let the trade off and let it set up again. But as it stands now, we're still holding up. Copper, or Dr. Copper, has a inside trading day, and it's holding pretty well, like right at that 3.77. So if this is going to consolidate and break out, that'd be a positive sign for probably the economy, probably the markets. But as it stands, I mean, it's not looking all too healthy right here. It looks like we just got overextended to the downside and we're bouncing, whereas we have a high, lower high, and the S&P 500 has a high and a higher high. And we've pointed out these divergences in the past, and it always led the S&P 500 lower. So a little bit of a concern there. Oil also, we had that big, huge gap up on some news, and then it got faded again today, but it created a long lower tail, which could very well be bullish to potentially bounce, but it's been very choppy, very volatile. If this starts breaking back down, I'd expect energy names to go back down again, which would really actually hurt the IWM. So if you want the IWM to do good, you'd want energy names, you'd want to see this bounce, and then also with that financials, because there's a big weighting there in the Russell 2000 with those two sectors. Let's take a quick look at bonds and yields. So bonds, it's within this channel. We reached the top end of the channel. Are we going to be breaking out of this? Is it going to go retest this prior October high? That'd be pretty wild in my opinion, and that would not be too healthy for growthy names, including what we've been seeing in the tech sector. So if that is the case, watch out. This move right here didn't even affect the tech sector, so it very well may here in the near future. But as it stands, we're just hitting the top of a channel, which means that we may very well get a bearish crossover, and this could start heading back down, which typically is good for bonds. I'll show you the TLT, but you can also look at other things like SHY, SHY, IEF, etc. Right now, as it stands, we had a good day today, right? It was up almost a percentage point. We came down, we bounced up, and now we're just right by all of these moving averages, right? So we had this stage 4 decline here, the moving averages, everything was sinking down. Now things are starting to coil up, tighten up as we hit this low point over here. You'd want to see price back above these moving averages. You'd want to start seeing them widen out, the low ones on top of the high ones, and then price action to bounce and move like that to know that we're, from an potential accumulation phase into a stage 2 markup in the price of bonds. Okay, let's just finish off here with the dollar. The dollar is also an important asset to watch, because if the dollar starts moving higher, well, things like gold can actually get hit. Things like the S&P 500 can actually get hit. We've seen that negative correlation, right? Dollar down, S&P up. Dollar down, S&P up. Okay, but as of recently, the correlation's not quite there. As the dollar's been breaking out of this channel, the S&P 500 has been moving up higher as well. So this is going to be be cautious here, because if the dollar says, hey, I'm going to consolidate and then I'm going to go for another leg higher, maybe that's when it starts taking out assets. We don't know at this particular point in time, obviously, but what we do know is this: markets move between expansion and contraction. So when we have that tight contraction, you can play the breakouts or you can speculate by entering in early, but have clear defined risk in the markets, because if it doesn't go in your favor, you can get out early for less loss than the potential reward if it goes obviously in your favor. That's all I got for you, everybody. See you later.